Morning, everyone, and welcome to our second quarter China update. And thank you very much for joining us. Tian, it feels like just the other day that we did the quarter one update. And as you've just mentioned, it's maybe a bit more of a boring quarter for you, but it seems China still continues to make headlines, whether it's on the stimulus side, property challenges, or the strength of its tech center. The market has picked up over the last quarter or the last month and a bit. So today, I hope you can cut through all the noise and focus what really matters for investors and give us some insights on what's happening on the ground there in China. As with all our webinars, just bear with us if we have any technical difficulties, and post your questions in the Q&A function, and we'll try and get to as many of those at the end of the webinar. Thanks, Tian. Over to you.
Thanks, Darby. Morning, everyone. Thank you for joining us on this cold morning, Monday morning in South Africa, apparently. So it's pretty hot here in Shanghai, about 40 degrees outside behind me, and about 90% humidity, as I understand. So I'm glad to be in an air-conditioned boardroom speaking to all of you. Like Darby said, it's been a bit of a boring quarter in China, but boring with markets rallying is always good. But I'll take you guys through what's been happening, some of the not so exciting stuff. Tariff progress, firstly. So last quarter, I think by the time we had the webinar, the Chinese and the US trade teams had just sort of agreed to the first 90-day truce that ended last week. So right now they've agreed to another 90-day extension, but this is pretty much where we stand. The table on the left was the original April 2025 reciprocal tariffs. All of these countries in these tables are more China related. So we obviously looking at a China focus. A lot of these countries are seen as transshipment centers or re-exported Chinese goods being shipped to those countries and then re-exported to the US to avoid tariffs. You can see originally all of these tariffs are ranging in the 30 to 40% range. Everything has come down. If we look at the table on the right hand side, August 2025 numbers on average half. China obviously down from 125 to 10%, but everyone else around half, or at least lower than what they originally were. Everything's color coded, so everything green on the right hand side of your screen would be a better or a reduction in tariffs. Brunei is the only country, it's so small, it's actually negligible, but they've gone from 24% to a 25% tariff. Singapore is color-coded yellow because they remain the same as at 10%. Singapore runs a trade deficit with the US, so they're pretty much the same. They're also a strong US ally in the region, so they're pretty much the same cap as the UK, who also have a 10% tariff. As we understand it, if you get a 10% tariff into the US, 10 to 15%, essentially that's the new meaning of a free trade deal with exports into the US. This is where we stand. China's 10% still temporary. We're going to have to wait another 90 days for any more developments. We don't expect any major changes for the rest of the year. Moving on, so effectively to summarize, the Chinese and the US sides pretty much agreed to disagree for the foreseeable future. It's the second 90-day extension. The 10% looks low, but that doesn't include the 20% fentanyl-related tariffs. So the number you'll hear Trump quoting is probably 55. 25 of the 55 was Biden-era tariffs. 10% is the current reciprocal tariff, and 20% is the fentanyl-related tariffs that he implemented in January and February this year. So currently, effectively, China playing with around an additional 30% tariff. We are actually quite optimistic on the 20% fentanyl-related tariffs to be reduced, but all very much dependent on US domestic sort of pressures on these tariffs. Overall, the outlook for 2025, when I say outlook, is outlook for Chinese exports to the US, looks fairly good. Very much linked to the US holiday season. I think there's too much domestic political risk with the midterms coming up next year. Nobody wants to anger any sort of voter base domestically. As I mentioned, the recent talks in Sweden, the further 90-day extension that takes us into mid-November, and then we'll see if anything crazy happens for 2026. Rare earths, there's probably the most exciting, if I can call it, a development of this quarter. China heavily restricting rare earth exports. Why does it matter? China processes or mines approximately 69-70% of global raw rare earth ore production. But the key is that the processing capability largely sits in China. So around 90% of global rare earths are processed and then re-exported from China. So there is no other alternative, at least for the foreseeable future. The US imports, on average, these are BBC estimates, if I remember correctly. US imports about 80% of rare earths from China. So they're going to have a major glut in rare earths as their stockpiles run low. EU has a 98% dependency on China. So it's actually crazy how dependent the world is on rare earths. Right now, China is fairly open to exports into the EU, very much clamped down on all rare earth exports into the US. Those are heavily scrutinized, so anything that is related to any military application is probably not going to get licensed. So there are still great exports of rare earths, as far as we understand, but largely companies, military-related defense companies like Lockheed Martin, like they're going to struggle. So all of your sort of F-35 stealth fighters require hundreds of kilograms of rare earths per unit. Those stockpiles, when they run low, all the production is probably going to be halted in a lot of defense-related companies in the US. That's probably the major impact. What we understand from the ground in China is that a lot of the exports of rare earths that's to be used in new electric vehicles. For example, your Fords and your General Motors will have already begun to receive shipments of rare earths or will be approved soon. So everything that's pure civilian use will eventually get approved, albeit a bit slower, or probably a lot slower than prior to the restrictions. That's one of the key sort of economic tools that China has when dealing with the US. Overall, our outlook on China remains positive, and it's getting more and more positive. I think a couple of the things, the Trump team continues to show more rationality as they sort of move further into this entire tariff, global tariff war, if we can call it. China is not really too concerned about current tariff levels. I think the focus domestically, what we are seeing in China, is that the Chinese are focusing more on discriminatory tariffs. So what that means is that if everybody else in the world gets slapped with a 30% tariff, China doesn't mind getting a 30% tariff because it's pretty much level playing field. But if China had a 125% tariff like they did in April, and everybody else was on 10%, that would then trigger more significant responses from the Chinese side. So as we stand right now, China is fairly comfortable given the level of tariffs to the rest of the world. Chinese exports continue to drive GDP growth even after the tariffs. So it's remaining very, very strong. And for the rest of 2025, we mentioned earlier that with holiday seasons like Thanksgiving and Christmas holidays coming up, we don't expect any unexpected tariff moves that will push up prices for the holiday season in the US, more due to domestic political risk. So overall positive in terms of geopolitical outlook. If we look at the latest data, apologies for the typo on the previous slides, it's for all of the data is up to July 2025. If we look at second quarter GDP growth, much better than expected. With all the tariff craziness, we were expecting a number well below 5%, but it turned out to be 5.2%. So quarter one was 5.4, and quarter two 5.2, which takes us above the official 5% target that the Chinese government has for the year. Unfortunately, given the good GDP growth numbers, there's less pressure for the Chinese government to push out fiscal stimulus packages. Or when I say fiscal stimulus, additional fiscal stimulus. So a lot of the consumption-related stimulus plans remain in place. We in Shanghai, I think they've just temporarily paused a lot of the consumer electronics subsidies that subsidizes 20% of your purchases. The next round will come out soon. All of these things still happening, albeit not massive once-off stimulus packages. CPI 0 for July. Inflation probably the only major concern in China. Prior to June and July, actually, there was 3 months of negative CPI, but it hovers around 0. So we are still nowhere near that persistent long-term deflation scenario that plagued Japan for decades. If we look at core CPI, it's the 3rd month of accelerating gains. So now we are close to the 1% mark. Ideally, the Chinese policymakers want CPI and core CPI to be around the 2% mark. But we're slowly heading there. Core CPI is getting there. So we're moving in the right direction, although it wouldn't be bad if CPI moved up a bit quicker. PPI, the concerning data, minus 3.6%, continues to be very low. A lot of internal competition between Chinese corporates, cutting prices, specials. If anyone that's been to China recently, and for those of you joining us for our China investor tour in a couple of weeks, you'll notice that you are able to get products and services in the West that cost 3, 4, 5 times as much for a fraction of the price in China for just as good quality. So PPI at a corporate level, not very good for corporate earnings growth, but earnings growth actually also returning. So CPI, PPI are probably the only not so good data points for the quarter, and they will probably remain so for the next couple of quarters. If we look at retail sales, up 3.7% in July, up 4.8% in June. So decent growth numbers, not up to the level of GDP growth of that 5% level yet, but they are steadily growing. So not a bad data. Exports are largely driving. So exports growing ahead of the GDP, sort of the 5% benchmark. So anything above 5% is a really good number. It's contributing positively to overall economic growth in a way that's above target. And new home prices, we just keep updating this data. I think our view remains the same. Probably from about a year and a half, 2 years ago, we said housing prices and the entire real estate sector is going to be a drag on GDP for the next decade. We continue to stand with that view. It's probably going to be a continual drag on GDP, probably for the next 7 to 8 years. So we're sort of already 2 years into that view. It's the ninth consecutive month of slowing price declines. But if we look at situation on the ground, property sector is still struggling. That's probably one of the main drags on the economy and one of the main negative impacts on retail consumption. If we look at PMI, the blue line, we're always sort of encouraged by the blue line sitting ahead of the red line. So the blue line is the survey that's more weighted towards the private sector. And the survey dates, the blue survey, the Caixin survey, they survey towards the end of the month, whereas the official PMI surveys happen earlier in the month. So you'll see that closer to end of July, later in July, confidence levels started to increase, both into the services and manufacturing. Manufacturing PMI will probably continue to hover around the 50 mark, but we are more optimistic about the services sector, confidence and overall activity getting better. Interest rates, I think this is a chart that we show quite often. This time we added the long-term China rate. So China 30-year rate currently heading back towards the 2% mark. So what we saw earlier in the year is that everybody just pouring into bonds, retail investors, hundreds of millions of retail investors with a lot of savings to play with, pouring into products that bought into bonds. You can see both the long-term and short-term rates getting compressed, not necessarily reflecting any realistic long-term inflation expectation. It's just the nature of the investment market in China, where it's just hordes of flows going to specific asset classes that are hot at a certain point in time. And we're quite relieved to see, if you guys can see my cursor on the right-hand side, both the light blue and the pink line heading up a bit. So sort of interest rates heading back into more rational levels. People are selling out of bonds, and also the equity market doing well also has a contributing factor to that, where people are disinvesting from bonds and buying into equities. So overall, the sort of interest rate environment getting more rational in China, and inflation, core inflation picking back up. So those are both good developments. If we look at Chinese currency, this is pretty much an extension from the chart we showed last quarter. The CNY continues to be heavily managed relative to the US dollar. We have seen some recent dollar strength, but relative to other major Asian currencies, the Chinese yuan is still 4% weaker this year. So it's stronger versus the dollar, but because the dollar has depreciated by so much, the CNY on relative terms has depreciated relative to other Asian currencies, which gives it a bit of an additional buffer for exports as well. Overall, we don't expect the CNY to depreciate, or even on relative terms against other Asian currencies to depreciate a lot further, more just due to political pressure. China is part of the largest FTAs in the world, and you don't want to have an unfair currency advantage against your sort of non-US trading peers that they are dependent on for GDP growth currently. So stability is what we expect in terms of currency. If we look at the markets now, so there we go. China doing really well. China doing really well this year. If we look at the tech, the CSI 300 up 7%. It's up more month to date. So these numbers don't include August. Last day of July was a bit of a blip. We've made up all the gains, and it's exceeded the highs of July again. So this month so far has been really good. The tech-heavy Hong Kong index up 23% this year so far, so up more in August. So in the combination, China on average the best performing market in the world. If you average the two, better than S&P and Nasdaq since January. If we look at how the two markets, these are two charts that I don't think we've ever shared before. These are Chinese domestic histogram charts. For on the left is CSI 300, on the right is the Hang Seng Index. So it's basically on the left China onshore, on the right China offshore. You can see these are daily box charts. So it pretty much represents about a 2.5 month period. You can just see on the left hand side the onshore market is just moving upwards, and then on the right hand side Hong Kong market also moving upwards. It's actually, we've always talked about Hong Kong markets being more volatile than the onshore markets, and you can see it in these daily charts as well. Hong Kong goes up and down and up and down, even though the overall trajectory is up. But I think overall, we thought it was interesting just to show you guys what sort of the Chinese investors and our systems here in China look at on a daily basis. Red and green colors are flipped. So on a red day, the market is up. On a green day, market is down. So you can see on the left-hand side, these are snapshots as at the end of Friday. So on Friday, onshore market was up 70 basis points, but the Hong Kong market was down 98 basis points, almost 1%. So the colors are completely flipped in China when you look at it. So when you see a screen of red, it's not a bad day in China. It's a good day in China. But moving away from that, some of the reasons we continue to update, valuation multiples remain low in China, both in the onshore and offshore market, both in absolute terms and relative to global peers. So relative to India, US, and Japan. India, obviously the main emerging market peer that we compare China against. China remains very attractive. On a cyclically adjusted basis, you can see China trending up a bit now with the recent rally, but it's still close to all-time low valuations. On average, China needs to rally, assuming earnings do not change in the current cycle. China needs to rally 100% just to get to where US and India valuation multiples are, just from a pure multiple view. So overall, you can see there's just a massive upside. Even though the market's already rallied, there's still so much upside for China just to catch up to the US and India. So it doesn't necessarily have to end up that way. The US and India might drop a bit, China might rally only 50%, and we don't know how long it'll take. But from a valuation multiple point of view, the point in time, and on a cyclically adjusted basis, China remains absolutely attractive. With that, moving on to Prescient China and how we've been doing. So I think overall, we don't cover our equity fund too much. Our equity fund is very much an institutional focused product. It doesn't give a lot of flexibility. It's limited to maximum 5% outside of China offshore. So our mandate is China onshore. As the maximum, we can deviate 5% off benchmark. So it's very, very much pure onshore focused. But if you guys do have a need for pure onshore equity access, this is a great product. So year to date, net of fees, we've generated about 2.5% of alpha over a 7-month period. As the year goes on, we hope to generate more. So that's how our equity has performed for the year of 2025, just a pure onshore equity component. If we look at our Prescient China balance, which is where most of you are invested and which is the product that we recommend for most allocators to China, we currently remain bullish. Our nominal exposure is actually getting close to 100%, even though our net exposure, accounting for a lot of the protection and the derivative structures we have in place, currently stands at 82%. 82%. So we remain bullish. We are positioned for the upside. By the end of August, you guys should see a lot of this. For example, overall equity exposure increasing along with the market and with our structures playing out. We still have protection on the downside. Hong Kong remains a volatile portion. If Hong Kong rallies sort of another 15-20%, we will probably start switching. So on the right-hand side, the light blue block, the 28%, light green block, sorry, the 28% is our Hong Kong, our net Hong Kong exposure. We technically have a little bit more on a gross nominal basis, but we will start cutting down on our Hong Kong exposure, which we currently have an overweight position of once the market rallies a bit further. The two markets in onshore offshore typically converge, and when the one runs away too far, historically it always comes back, and fundamentals in the onshore market remain very strong. So looking at our top 10 in our Prescient China balance fund, this is where you'll see, especially this year, probably for the last 18 months, the major difference between our Prescient China balance and our Prescient China equity fund. So you'll see we have 3 major tech holdings in our top 10, whereas we don't have that in our pure equity building block. And overall, these have contributed a lot to our alpha, to our Prescient China balance for alpha this year. So Tencent, many of you will be familiar with, and the other 2 names, Alibaba and Xiaomi. Xiaomi phones, I'm sure many South Africans are aware of, and also selling very, very well in Europe. Alibaba, Jack Ma, also world famous. So these 3 holdings have really contributed to our alpha. If we summarize the performance of these 3 holdings, Tencent, the worst performer of the 3, doing just under 32% year to date as at the end of July. Alibaba producing 41.3% year to date as at the end of July, and Xiaomi giving us more than 50% year to date return. So these 3 have really contributed positively this year to the fund's performance. Overall, we have outperformed 100%. So this is benchmarked to onshore equities because it is the larger component and our main equity benchmark. So overall, we've beaten 100% equities in this multi-asset strategy by 3.5% year to date. That's 3.5% net of fees over a 7-month period. Over the long term, these are long-term numbers you guys are familiar with, but year to date, our official benchmark is CPI, China CPI plus 3. So year to date, we've outperformed CPI plus 3 by 11.2%. We've outperformed a typical 65-35 China balance fund by 5% net of fees year to date. Over the last year, we've done 21.9% ahead of China CPI plus 3. Obviously, a function of the equity markets doing well, but relative to a standard 65-35 China balance strategy, we've outperformed by 9.2% net of fees. So I think we're quite happy with the performance of the fund over the last year, and we continue to manage the fund very actively to try and capture a lot of the market rallies and then protect and smooth on the downside. That's typically the strategy followed by this fund. Over the long term, this is all public data. If you guys log on to the Morningstar website and look at the rankings of our fund, The Prescient China Balanced Fund is ranked number 1 globally within the Morningstar universe of China multi-asset funds. Number 1 over 5 years and 10 years. So we're very proud of that as a house that comes out of South Africa, competing with all the big names globally. Over the 10 years, if you guys can see my cursor, it says 2. It doesn't mean that we rank number 2, or perhaps it does, but it's a percentile rank. We are ranked 2nd percentile out of 38 peers that survive more than 10 years in China. So 2nd percentile out of 38 peers means we rank 0.76 out of 38. So I think we ranked first. That's why I said we ranked number 1 over 5 and 10 years. If any of you know, think we've calculated wrong, please get in touch. We would also like to understand these rankings better, but we're quite proud of our long-term rankings and will continue to actively manage the fund. This is our standard long-term brag chart. This is MSCI emerging markets, total return, MSCI China total return since 2013, CSI 300 total return since 2013, Prescient China Balanced since 2013. So again, showing the 1 year and year-to-date chart shows our short-term performance. This is a reflection of our long-term performance. We've outperformed. Everything is net of fees. MSCI emerging markets by 82% cumulatively since inception. MSCI China by 71% since inception, and CSI 300 by 62% since inception. So proud of those results. Continue to work hard to maintain these results for the next decade. So in summary, we have pretty much some of the most attractive valuations, even with a 25% rally in Hong Kong and sort of a 7-8% uptick in the onshore markets. Both in absolute and relative terms, China remains the most attractive major equity market in the world right now. We are still at the bottom of the cycle. So I think three main points. So average earnings in China, corporate earnings in China, earnings multiples, as well as the currency. All three of the major pillars of financial markets in China, we feel have major upside over the next 3 to 5 year cycle. So right now, we're certainly very, very bullish on Chinese markets, Chinese equity markets, not necessarily fixed income markets. So we believe right now, if you don't have any China, a very good time to allocate. We've been saying that for 6 months at least now. If the Chinese market rallies very quickly. So if you do have China and you have capacity, it's probably not a time to add a little bit. Geopolitical landscape right now is in China's favor. We've seen the major fight in April, May with the bilateral tariffs between China and the US administration. Pretty much China coming on top of that. We don't expect major geopolitical risks. Right now, it seems that the focus has shifted towards Russia and Ukraine, no longer on China. So I think we'll go through a quiet and smooth period in China for the rest of 2025. So that's good news. And again, I think last point we always mention is China is a volatile market. You really need to be experts in China. We don't believe that sitting in London or New York can help us manage China very clearly. That's why we sit in Shanghai, and we believe our balanced fund is most suitable for most investors. So with that, open to questions. Please let me know if anyone has any questions. I think we'll look at the Q&A panel.
Thank you, Tian. Less than 30 minutes there, so nice, short and sweet, but good update. Got a couple of questions here. Let's start with how do the CAPE ratio look across the sectors versus India? Don't know if you know that offhand.
We need to do some more work, but if we look at the overall results, we would expect that every single sector in China will be significantly cheaper than India. We can't, if I record the data we look at, I can't record any sector in China at sort of a close, perhaps biotech, but perhaps biotech and specifically semiconductor related sectors, but those are such small components that, for example, semiconductors, India wouldn't have an equivalent sector, but biotech is probably the closest. But as far as I understand, so if you strip out all of the rubbish in Chinese biotech, then on average it should still be cheaper. But those probably the exception. But on average, everything is much cheaper in China relative to India.
Let's stay on the technical side of things, and then if you can focus on tech valuations versus its history.
Yeah, so if we look at, Tencent is the company that most South Africans are familiar with, and it's actually the tech company in China. Let me move back to that slide. It's actually the company in China that's okay. Xiaomi is obviously not the same type of tech as Tencent, but Tencent is the only one that's getting back to its 2021 peak levels. So Tencent is probably about 25% away from its peak, its absolute peak of about 700 Hong Kong dollars. Right now it's approaching 600. Maybe not yet, but it's in the 500s and approaching 600. So we're probably 20-25% away from the absolute peak. Whereas on the flip side, Alibaba, as an example, is still less than half. Alibaba's peak was 280 something Hong Kong dollars. Right now, I think end of today, it's probably around 120 Hong Kong dollars. So it's still less than half. So overall, tech valuations if you look at it solely from a Chinese perspective, it's still very cheap. So if you look at Alibaba and Tencent, they are still the same companies that they were 5 years ago, just stronger, more competitive. So there have been more regulations limiting, for example, Tencent's ability to buy up more competition. But ignoring that, Tencent remains the dominant player, for example, in online gaming. You have ByteDance coming up, challenging certain sectors in Tencent, but for example, valuations still much cheaper on average at a tech level compared to the 2021 peak. If we look at Alibaba, for example, a company that we really like in our portfolio, that's why we have it in our top 10, is that if you strip out all of the cash that Alibaba has, you're sitting at single digit. Depending on how much it's moved today, you're probably looking at a PE ratio of 8 to 9 if you strip out cash. And when I say 8 to 9 to be conservative, when we last looked at it a few days ago, it was between 7 and 8. And if you look at, so if you ignore all of the US tech, a tech company that's absolutely dominant in online retail in China, absolutely dominant in terms of cloud tech in China, cloud business in China, absolutely dominant in our view in terms of AI models in China. In Alibaba, you're getting it stripping out cash for like 8 PE. It's an absolute steal. So this is looking at it in a specific Chinese concept. Then when we look at it relative to all of the US tech companies, the only thing that the US tech companies have on the Chinese companies is that their earnings multiples just keep growing faster than their earnings themselves. So it's two different markets, two different groups of retail/institutional investors that have demand for these assets. But we would obviously our specific team don't play in the US tech space, but in a lot of our work we have to understand the global tech landscape. Overall, probably in terms of valuations, cheap, both in absolute and relative terms, and probably some of the safest, if I can call it, safest tech to hold for an entire cycle. If I bought into the top tech companies in the US right now, I wouldn't be too comfortable holding them blindly and not looking at it for 3 to 5 years. There might just be some sort of earnings, not earnings upward surprise that sort of crashes the stock prices. It's got high valuation multiples and high earnings expectations going forward. So on a relative basis, we are very bullish China tech. Well, I said earlier, if it rallies another 20% or so, we'll start switching out. We'll probably start switching to underweight. Doesn't mean that we won't hold any, but the market typically needs to have a break. And that comment was more on a relative basis of China offshore in Hong Kong and China onshore in Shanghai and Shenzhen. So it's more of a relative play than an absolute sell play. Hopefully that answers the question.
Cool. Then on the fixed income side of things, are real rates positive across the curve in China? And if so, will the monetary policy be enough to give the economy the kicker it needs?
There's very good real yields in China. Let me get to that slide. So if we look at both short-term and long-term rates, so the volatile blue line, dark blue line, the navy line is China CPI. You can see since about 2023, since the beginning of 2023, late 2022, we've been the red line is short-term 2-year rate, and the line at the top, the sort of flattish light blue line, is the China 30-year rate. So both these rates give us significant real yield, which is pretty good, but in absolute terms, we're sitting at 2%. And CPI can potentially have sharp upside. The problem with fixed income is that at 2%, we don't see a lot of scope for central bank lowering rates in China currently. And lowering rates, as part of the question you asked, is that we don't believe has that much of an impact on stimulating an economy. A lot of the stimulation would have happened when rates dropped from 3% to 2%. Right now, short-term rates are 1.5%. If dropping from 1.5% to 1% may help with the struggling property sector, dropping it to 50 basis points will help the property sector, but it's not going to help significantly the more productive and more active parts of the economy that you want to try and promote growth in. That's the problem we believe the policymakers are facing. There's a lot of credit available in the Chinese market for SMEs. When we do our on-the-ground research, there's a lot of credit available, but there's not necessarily the same amount of credit demand from SMEs. People are, or small business owners are reluctant to take on debt due to the uncertain future. There's a lot of people trying to arb the low interest rate debt to try and funnel it into property, funnel it into stock market, etc. But it's not getting to where we really want the money to go to generate real tangible economic growth. So that's probably the problem faced by the monetary policy makers. So that's why my comment earlier about fiscal stiffness. So I think that's probably the more realistic sort of kicker to help Chinese economy grow better. Not that it's not growing well now. At 5.2%, it's still pretty good.
Thanks, Tian. Maybe this question, you can use it to sort of explain how we call it pick stocks within the fund, and how overweight and underweight works against the index. So what exposure do your funds have to rare earth miners and processors? So
the exposures will be tiny and negligible in our portfolio. So I think, like you mentioned, David, we are not stock pickers. So Prescient is a systematic house. In our China process, so by default, we're not stock pickers. We don't pick 10, 20 stocks that we believe will do well, and then sort of try and live with the interim volatility. What we try and do is we start with a benchmark as a base, and we do small tilts within the benchmark. So the benchmark that we typically work with in our China process is the CSI 300. So there's 300 stocks, but below the top sort of 80, 100 stocks, the weightings become negligible. So a lot of these rare earth miners, not many of them are listed. The ones that are listed with exposure to rare earths would be very small in our portfolio. We typically, and also with typically these sort of geopolitical binary type of companies, we typically would not want to take bets on it, because you either get it all right or all wrong. Your base case fundamental thinking can be right, but you can get it all wrong if markets just don't play away. So typically with these binary type of scenario outcomes, we tend to try and manage our risk by just holding benchmark weight.
Thank you. I'm going to chuck 2 questions into one here, and then I have one more after that, and I think then we'll call it the morning. The questions we didn't get to, we'll send you an email with the answer. So what's the biggest, or what do you consider the biggest risk for the Chinese equity market? And then what's your thoughts around future growth dynamics given the aging population?
So there's sort of, so this is going to sound too positive, but as we stand right now, there's not a lot of fundamental risks for the Chinese equity market. So the three pillars I mentioned earlier: earnings, average corporate earnings have been so depressed over the last couple of years. I mean, it's been COVID, and then it's been sort of regulation clampdown, then COVID, this crazy strict COVID, then a slower recovery out of COVID, then all of the tech sanctions from the US, now the Trump tariffs, etc. So everything that could go wrong for China has gone wrong, and this is where we are right now. So we are pretty much already in the biggest risk scenario, and all of these, in terms of domestic policy response and economic response, China has sort of held up well over the last couple of years. I mean, up until 2023 was a really bad year. 2024, last year, it felt bad, but if we look at the numbers, markets are up double digits in China in 2024. 2025 continues to be the case. So I think the biggest potential risk may be geopolitical and something out of China's control. So, for example, the reciprocal tariffs that came out early April and really shocked the markets. Hong Kong was down 8% in one day. Oh, no, sorry. Hong Kong was down, I think, 10% in one day. Onshore was down 8% in one day. These are sort of the unexpected shocks. But as Trump's entire plans get revealed through media, through negotiations, we see less of that irrationality, the risk of that type of geopolitical irrationality coming through. So we actually don't see major risks in the short term for the Chinese market. In terms of aging population, in terms of growth and aging population, we don't see it as a problem at all in China. So yes, aging population is a long-term. It's more of a so how the Chinese describe it is more of a sort of cultural survival crisis. Whereas in a couple of hundred years, if we go in by the low birth rates that we have today in China, all the Chinese people in the world will be extinct. But that's a problem faced with all developed market countries. And the sort of flip side problem is that if we look at Chinese youth unemployment, even with the declining birth rate, Chinese youth unemployment is 3 times the average national overall unemployment rate. So overall unemployment is around 5%, youth unemployment is 15%. So even with less and less young people coming into the job market, there's an unemployment problem. With a lot of the automation, with a lot of the labor-intensive industries moving to Southeast Asia, and AI coming through, I think in our lifetimes we will probably be more faced with an unemployment issue rather than an aging population. But sort of for our children's lifetimes, maybe if the government does not fix a low birth rate issue, it will become a problem. But we are already seeing sort of birth subsidies. So, for example, the national government has rolled out per annum about 3,600. So that's at the national government level. Different provincial governments can add on top of that. So our neighboring province in Shanghai, Jiangsu, is rolling out a 5,000 CNY per annum sort of, I don't know, just cash award for anybody with children under the age of 3. So it's to encourage more birth rate. So that's the equivalent of 12,500 rand. So you're getting on average over 3 years close to 40,000 rand as a cash reward for having a child. Not a lot of money because children are really expensive, but it's a good start. I think there's a lot of policies in the works to try and encourage more birth rates.
Thank you. Well, 2 questions we didn't have this time around was geopolitics in Taiwan. We'll skip that one for today, and then can't have a webinar without property. So if property continues to decline, say for the next 8 years, would it? And what would then happen to consumer confidence?
So I think property won't necessarily decline. Obviously, if it was purely market dynamics at play, property companies will go bankrupt. But there's a lot of policy intervention because it's a massive social issue. If all of the property developers went under, there would be a massive social issue affecting the lives of average Chinese people. So government has pretty much intervened to stop the absolute collapse of a lot of bad players in the property sector, just to ensure their social stability. The cost of that is a lot of the fiscal revenues being spent on the property sector could have been spent on way more productive areas of the economy. So that's what we mean by property sector continually being a drag on the economy for the next 8 years. And the question on consumer confidence is absolutely yes, for probably a decent amount of the population, but for the majority of the Chinese people, probably not much of an issue. Majority of the Chinese population probably could not afford to buy a property. So what the property sector downturn really impacted was your wealthier middle class and your wealthier spenders that really cut down on their spending over the last couple of years. So we are seeing that in retail. So the worst was sort of 2022, 2023, when you saw that consumption just drop through the floor. We are starting to see that coming back. So your upper middle class and your wealthy individuals, after a while, they realize the reduction in property values is largely just paper value, not necessarily cash flow impact. I think we've talked to that over the last 18 months or so. So once people realize it's not really a cash flow impact, they realize they have cash to spend, and the consumption slowly comes back. Over the long term, we're actually positive on a bit of a Chinese property collapse, if I can call it, is because if properties become more affordable for the majority of the population, it means that people don't have to spend 80-90% of their disposable income paying back a bond. They can spend more of that on consumption-related items or services that grows other parts of the economy, and not just the property sector. So overall, over the long term, that's actually a healthy development.
Thank you. I think let's call that the day. Thank you everyone for joining us today. And this, as with all our webinars, the recording is available on our YouTube channel. You can go and search for it there. The questions we didn't get to, we'll pop you an email on that, and have a great week. Thank you, Tian.
Thank you, everyone.